Hi, this is John Firth of Firth and Friends, and this is the last broadcast we're going to make in the first half of 2025. And I'm thrilled that it's on the subject of how to use the equity in your firm, because at least in my practice, this is one of these conversations that is never rich or deep enough, and where can be easily mistakes made that when it's evident that they've been made either with a shareholders agreement or how you use your equity, that you wish you had spent more time up front, really understanding the ramifications of your decisions. So I have with me here Gretchen Harders. She's an expert in all matters equity, specifically as it relates as it's used as a form of compensation, especially with startups and tech firms. So we'll be exploring that, but we'll talk a little bit about investors as well and using equity to attract investors. So Gretchen, I'd like you to introduce yourself. And I have a question for you, which is, what are the 2 or 3 biggest mistakes that a CEO or a business owner or somebody who's making the decisions about equity makes, those mistakes that they make up front that can have wide-ranging ramifications or consequences later? So please introduce yourself.
Thank you, John. I'm an advisor and attorney with the law firm Cohen & Buckman. I specialize and focus on executive compensation with a experience with equity compensation, which is a big piece of how executives and other employees are compensated. It's an important part of the practice, and it's an area that is very interesting and challenging. So John, you asked a great question. What are the 2 or 3 biggest mistakes that people make? I can talk a little bit about what I've seen and a couple of things just to be just about. I think one of the first mistakes that I see is that promises are made to provide equity to your key management and employees, and they're not ever actually documented or granted or awarded properly. This raises a number of issues. Oftentimes you'll see somebody says in an email, I'm going to, you've been great. We have lots of discussions. We want you to have an ownership. Let's say you have a great, significant, contributor. Your COO is doing terrific and is really important to the future of the business. So you say, I'm going to give you 5% of the company. But what does that mean? What does 5% of the business mean? And then nothing else ever happens. So there's an expectation and it's not fulfilled. So this is the biggest mistake that I see. When you're offering equity, there's a lot of different forms. Oh, go ahead, John.
No, I was just going to mention that I have seen all sorts of things I'll just give you a recent example. Obviously, I won't mention the client, but he had promised one of his first very important hires 10% of the company. And then about 6 weeks, 2 months into it, he realized this guy did not walk on water necessarily. And I thought 10% was rather high. And so he actually formed another company that takes all the work that would have been done as part of the full entity, puts it in a separate company and gives him 10% of that. So he's had to backtrack. So he actually did make the award after about 2 months and then regretted it and changed it. And those are the sort of things that you put yourself at risk, because if the employee is an important one, they could easily just walk if they say that I don't understand what you're doing here. So that's an example of what can happen if you don't think through it.
It's a great example, and that's exactly some of the things that we see where a promise is made, but it hasn't been thought through at the front end before making the promise and what that looks like. Also, I would sort of agree with you. What's market? That's an important aspect. 10% seems particularly high. And we see generally, again, there's different market practices, there are different businesses, but we often see sort of close to 10% set aside, somewhere in that range for executives and employees, depending how deep you want to make awards and maybe your key people. If you have a CEO, looking closer to maybe 60% of that 10% and, or 40, somewhere between 40%, and then, different grants depending on participation. But that's always a risk, right? To bring people in and to, bring a new person in, making this promise and not really being prepared to paper it. It raises issues of expectations, and it's a really, really difficult sort of consideration. The second biggest mistake The second biggest mistake I've seen, which really relates to that, is um, looking at what is the structure, what is the type of equity that you're offering, and
Mhm.
how do you value that? Like, what is the valuation? So, a lot of what you're offering depends on if you're a corporation, if you're incorporated, if you're
Mhm.
a small business corporation with small,
Mhm.
qualified small business stock, if you're a partnership or an LLC, and that really
Mhm.
drives the type of equity that you can give. And it becomes very technical. It also becomes very tax based. And you have
Mhm.
to look at your corporate governing documents, your shareholders agreement, if you have one, how much you're going to set aside. And there's a lot of different considerations and planning that go into the type of equity that's offered. We also see, sometimes, small businesses, they want to give, 10% to the management team, but they really don't want to, they worry about dilution, they worry about giving voting rights, they worry about the type of equity. Oftentimes that's addressed through sort of a phantom equity type of arrangement, which also has its own complexities, but they're not actually owners, but they get the value of being owners. And
Mhm.
it kind of goes to the heart of, when you're thinking about giving these awards and what they mean structurally, you're really thinking also about what's your end game, what's your policy, what are the things you're trying
Mhm.
to accomplish? Are you trying to
Right.
hire key people? Are you trying to keep them incentivized and aligned? And it's really important, particularly in a small business, to have folks feel like they're owners and that they have
Yeah.
a participation in the business.
Yeah, I would take what
So
you the things you said, and I would turn that into one of mine, which is the whole question of really, if you have a strategy for your company, you should, i.e., having some markers, end of 1 year, at end of three, and end of five, with a longer term vision. There, you should, for, what is it? Form follows function. Is, if you've got the strategy, your equity strategy should follow that. If you know what an end goal is, for example, if you plan to exit within 5 years, that will require a different kind of equity structure. If this is going to be a family business for generations, that's a completely different structure. So having your strategy, and above all, whatever exit you want to call it, should play a huge role in your consideration of the kind of equity. I guess I'm asking that as a question too. Would you agree?
Oh, I absolutely would agree. And it really goes to, I mean, equity is such a great tool because it provides not only the sense of ownership in terms of your management team, it
Mhm.
also acts as a retention tool. You don't want to lose your valuable,
Yeah, right. It's a great retention tool,
members.
actually.
And so you provide vesting schedules and you give rewards so that they are, participating, and incentivized to stay in the long term. And then looking at what is the long term? What is the long term goal? How do you,
Right.
are you really trying to keep people for 10 years, or are you really looking to sell in the short term or even sell in the long term? And,
Yeah,
you know,
that's a good point you made. The other thing is, just like my client discovered, the person you hired isn't quite who you thought he or she was, but you've given them,
mhm,
2 or 3% of the firm, and it's hard to then dislodge them. Now, I don't know employment law that well, but I think after 6 to 12 months, you probably can still fire someone because maybe you haven't started vested or some vesting. But yeah, you can misspend your equity if the person that you hired isn't the person you thought you had hired.
yeah, it's sort of like it's sort of a double-edged sword in that sense because you have, at the beginning, you really want to reward these people, but you also have to think, and I think, going from the first thing is making promises and expectations and how you manage that relationship, and then what happens at the end of the relationship if things
Right.
don't work out, if it changes, you've made a hire that maybe wasn't the right person and you have to pivot. So then one of the things that you do in terms of equity awards is, when you make those commitments, you paper them carefully and consider what happens at the end. When things are going great, I think really the third biggest mistake I was going to mention, John, is that,
Mhm.
when everything's great and things are going well, wonderful. When things aren't going so well, then you have to look at what rights you've given the person. And a lot of it goes to, so, even if folks are there and they're vested and you've made these promises, what are the buyout provisions? Are you going to be able to sort of repurchase the shares?
Mhm.
What if this person did something that was wrong, and you really don't want to pay them maybe the value of what they're owed and how you address that.
Mhm.
It also, talks about sort of because liquidity for a small business is an issue, and will you have cash to do a repurchase? Do you have those rights? And you need to paper them. They need to be contractual rights. Otherwise, you can end up with a dispute at the end of the day. So
Yeah,
considering, what those rights are, and you also have to, one of the challenges I think for small businesses is that depending on the type of equity you're giving and the type of repurchase rights and tax treatment, you have to consider different valuations at different times. And you
right.
have to sort of have a valuation methodology, and the different types of
Yeah.
equity have different sort of requirements for that. So, considering what is not only what is the value of the individual and the people that you're incentivizing, but what is going to be their ultimate value.
Yes, exactly. So
And
it's yeah.
communications on this are critical.
Mhm.
What are you promising? How do they understand it? This is not necessarily a lottery ticket, right? This is,
Right.
sharing in the value, being aligned with your interests, being aligned with ownership, but also being able to manage expectations on retention and having people understand, when they leave, this is what's going to happen. These are the awards we're
Mhm.
making up front. And I think these are really the biggest mistakes because it is not a simple area necessarily. It does have its
Mhm.
own complexity,
Technical, it
and
gets
if you're
very
not,
technical, very yeah,
it
it
can
gets
it
very
can get
technical.
very technical. And sometimes you go off, again, there's maybe a more simple cash-based award or long-term incentive that might be tied to value or
Mhm.
performance targets like, shareholder return, EBITDA, revenue. So there's other ways to compensate if you're not quite at the level of that mimics ownership or provides those incentives without actually going in and looking at corporate
Yeah,
structure.
you bring up
Um,
another good point. I think what one should consider also is the lifestyle choices that someone has to make if they get more stock than say cash, or if they get more cash than stock. Some employees obviously are getting ready to get married, maybe have children, and if they only have equity that vests in 5 years or a big majority bulk of it, you may end up with an employee that's highly distracted by the fact that he just can't get ends to meet, or she can get ends you get ends to meet. Maybe something I don't see that quite so often, but that is something to think about. Is it does force a certain lifestyle decision if you're going to make equity instead of compensation. Compensation. If you're going to do compensation plus the kicker of equity, that's a slightly different conversation. But I would say you have to think about the people and how they're going to survive and be happy and be productive based on what you've put together as a compensation package.
Absolutely. And that, usually what we typically see is, it's the senior level management that gets the bulk of
Yeah.
the equity. And you always hear the story of like the Silicon Valley startup where everybody in the organization gets a piece of the equity. They're taking a lot less cash comp
Right.
with the
Right.
idea that there is going to be a big payout at the end. But those also raise different types of issues. And the more people that you have that have the equity, the more careful you have to be with structuring. And
Right.
there's always
Exactly.
added consequences. You can't plan for everybody's situation, but you really, as owners, you're really looking at the business as a whole as well as the owner's
Mhm.
goals and really, what you want to see and what communications you have with these employees to make sure that they're productive, engaged, understand what they're getting, and that it aligns with the business goals and their own, individual, as a
Yeah.
manager, what
Personally. Yeah.
individual goals and how do you align those?
Yeah.
So
No, that's good. It just occurred to me as we were talking about that really have to take in consideration what the employees will be experiencing, given whatever the compensation is. It's probably, is it safe to say that the younger the workforce, probably the more chances you have of being able to entice people to join you with stock than say compensation, because their costs tend to be a little bit lower than say somebody in their 30s who's starting a family. But that's not here. It's just a thought. So I would add one more
raise
thing to, sorry, sorry.
I was going to say that raises a good point because what you see, and I even seen the difference between some of the West Coast and East Coast sort of equity
Mhm.
plans is that you often give more equity with a younger workforce and you don't have retirement provisions or repurchase. They
Right.
leave, they're gone. So it sort of more aligns with maybe the expectations of the workforce, where if you have
Mhm.
a more, spread out workforce, you may, we will see a little bit more on the planning and, sort of provisions that protect people, as they plan towards retirement or more liquidity and different protections, to again, you're looking at your market, you're competing with others. So, and to keep that, to keep your people motivated, you'll look at that. But definitely with the younger workforce, it's really more, short term, it's also more what industry you're in and what
Mhm.
others are offering and whether you're competitive with those packages.
Right, right.
So,
Yeah, I would only add one more thing that I think a mistake is, and I've run across it several times, which is the actual shareholders agreement. I was once worked with two co-founders. This was 5 or 6 years ago, who were about to, because of the shareholder agreement, that I don't know exactly how it was worded, but they were going to shut down the company. It was a very profitable, lucrative company in face of some certain disagreement. And there was a huge disagreement, the fundamental classic co-founder disagreement where one thinks the other one is working less hard than he is. So the head of sales thought that he was working harder. After all, he brings in the revenue, and therefore he's just a more important person than who was nominally the CEO, who said, "Yeah, but I keep this all together, and I'm battling, on many fronts that you don't see, from investors to employees and so forth. And we wouldn't have a company if I wasn't holding it together." I got them back together pretty quickly and laughing and understanding because they saw it the same way. But like, who formulated a shareholders agreement that said you're going to dissolve your company upon this kind of a disagreement? It seems, they were going to lose potentially millions of dollars of not having that company. And I can't remember what they did. Oh, it was IT related technology. It wasn't like they could go off and be on their own. That wasn't sort of their psychological makeup. They did really sort of need each other. But yeah, so the whole shareholder agreement thing, just weird codicils that are put in there that, no offense, but some lawyer might put in there where nobody really thought through what that would mean in the case of. So those are the two I would add. Plus the one I mentioned like 5 minutes
yeah,
ago.
and that's,
So
that
sorry.
it's super important to paper it. I said it's super important to paper it. And if you don't paper it properly and, maybe what you thought in 1 year and 5 years down the road, circumstances change. And if you're not being actively looking at your governing documents, that's where you end up in litigation down the road.
Mhm.
And oftentimes you don't want to think about the end of the relationship, if you're two founders and people know
Unless
each
it's
other
very
very well, or
explicitly part of the
family
strategy.
members, that's
Yeah,
very difficult. You have to think through those, and those aren't easy. And people always think it's going to go great, and then until it doesn't. So
yeah. And I think what we really boiled it down to is you got to have the end goal in mind. More concrete about what you
absolutely,
think this is going to look like at some point in time, and stick to it. The better chances you have of formulating the variety of strategies, but especially the equity strategy. So I just want to quickly say this is John Firth, where I'm talking here with Gretchen Harders, and we're talking about how you spend your equity. If you're a CEO or business owner, this will definitely take up a significant portion of your time. Probably not necessarily in the first 6 to 12 months, but at some point you're going to have to make decisions, and these are not easy decisions to make. So, Gretchen, let's talk about the decision-making process. What have you seen? I know what I've seen or not seen in terms of the actual process of making decisions. You have a lot of constituents you have to think about. We talked quite a bit just now about the elements of the decision, but let's talk maybe about the process of making the decision. When does it usually start, and why does it start?
I think often, depends on the size of the business. I think it starts in two ways. One is the conversations that the management team is having and the expectations, and what is the expectation in the market. Right? It's on hiring and it's on retaining. So those were the
Yes.
discussions often start. But in terms
Mhm.
of the decision-making process, once the discussion starts and once the thought processes are going, it's really top down. So you may be
Right.
talking, if you have an investor that maybe has some preferred equity or some other, they're often involved. It really is ultimately your structure is the board if you have a board or the founder
Right.
or owners, and they're the
Right.
ones making the decision making process. And so they should be engaging the appropriate advisors and really thinking it through. And then
Hmm.
it's the administration and paper that comes from that. But it really has to be at the top level in terms of these types of decisions because it impacts your corporate structure.
Hmm.
It impacts investors as well. So
Uh-huh.
that's a really important piece. I'd say the start, though, is you have people demanding it or wanting it, or you as an owner, you want to reward people. So
Right.
that's the initial reason, and then it has to be top down in terms of the decision making process. And
Mhm.
more
Well,
thought at the
so
beginning means fewer headaches down the road.
yeah, it's kind of like the way life is. Um, what how do I put this? To what extent do or should somebody like the decision maker, possibly the CEO or his CEO with his COO or something, how much should they really be out there listening to their various constituents? Or is it at some point you say, look, too much input and also too much asking might weaken their ability to make good decisions? How much input do they need? I think what I'm hearing is an advisor is probably one of the best ways to go, who has the knowledge in the background.
I
But
think
should they really be
absolutely,
actively quizzing people about how much?
absolutely.
Yeah.
No, I mean, I don't think that's again, it's like people will raise the issue, and that's often how this process starts. But the process from the top should be looking at appropriate advice, right? And looking
Hmm.
at appropriate, it takes a lot of looking at your corporate governing documents to getting the right advisors to really decide, well, what is the
Hmm.
form and how are we going to do this and what is the tax? You don't want to, the difficulty is, the conversation maybe with the management is what percentage and how much and what are the
Hmm.
economics of it. But really it should be controlled at the top down. And it often is like looking also at what's market, like what, we're looking at what others are doing. And sometimes a consultant can help you with that, and a consultant can be good in providing that. So looking at different types of advisors and looking at advice, and then going through the process of papering it, you also want to look at consistency. You're offering one person this and then other person another thing. You're better off having a plan, some kind of executive plan, or management plan or equity plan. And that's really important because you want consistency down the line. And where the differences are is maybe in the value, the amount, the economics, but not so much in the other
Yeah.
features,
Yeah.
particularly as you get bigger.
Yeah,
Yeah.
and it's true with really anything involving money and employees. Employees will always talk about things, coming out of a review or comparing salaries. And there's nothing worse, I think, if you see that there's an inconsistency in how awards have been made. When I was at Discovery, it was a formula. Whatever your title was, your seniority, and so forth, there were certain grants that were made, and they were very uniform, so there wasn't a lot of dissension among the ranks, thinking, oh, well, why did she get more than I did, and so forth. And I think that's important because like everything dealing with compensation, employees will talk, they'll compare, and they can get
We have
a
to
little bit
expect that.
uppity. Yeah. So tell me about the different forms. I have to say, I have an MBA, but I've forgotten really. I mean, there's so many different kinds of equity you can grant, and like how many different kinds can you offer. So that's a bit of a black box. And if it's for me, I'm sure it is for a lot of our listeners. Open that up a little bit for us.
Mhm. So, I mean, the first question is, what's your corporate form? Are you a
Mhm.
corporation? Are you a partnership? And that
Mhm. Right.
the different types of equity sort of flow from that. So,
Mhm.
if you have a partnership, an LLC, often given what we call profits interest or carried interest, you often see that in certain industries. If you're structured as a corporation, you're more likely to see, let's say you're in Silicon Valley, where stock options were a huge, part of equity ownership. That has changed. That
Mhm.
has consistently changed over the years, the percentage offering options versus offering, more of what we call full value awards, which is like restricted stock or restricted stock units. So there's
Mhm.
definitely
Mhm.
different trends in the marketplace, and there's different trends based on if you're in the Northeast, if you're in,
Mhm.
Silicon Valley, if
Mhm.
What industry are you in? Are you in tech? Are you in tech life sciences? Are you more sort of more traditional industrial business, manufacturing? What are you going
Mhm.
to offer? And I think, but first question is what's your corporate form? And then the second is what type and form of equity you're going to offer. And they
Right.
all have different legal requirements. They're all complicated.
Can we walk through
And
some of them? There's the normal
there's
stock grant.
you're never going to get it perfect in terms of all the things that you might want, all the things that you want.
Yeah, can
Sure.
we walk through some of the most
Normal
common ones?
stock
I mean,
grant. So if you want
there's the
to,
regular.
and there's also special rules if you're qualified small business corporation.
Mhm. Uh-huh.
The most common ones. So what a stock option does? A stock option is usually not so expensive from an accounting standpoint. So a stock
Mhm.
option it's like a contract. So it's the right to purchase the stock at a future date at the fair market value price. So you have a
Mhm.
valuation and you have
Mhm.
a vesting schedule and you have the opportunity to exercise in the future. There's income and taxes at the time of exercise between
Mhm.
the spread,
Mhm.
and then the individual owns the shares. So that's common. That's, we've heard about that for years. And it's really, that's how
Mhm.
often. So it started really a lot in Silicon Valley where they're trying not a lot of cash.
Mhm.
How
Yeah.
do you provide it? It makes a lot of sense when their valuation is low. Another
Yeah.
one is restricted stock, which is really a full value award. They're being awarded the shares and subject to restrictions. So they're still subject to forfeiture, but they're really full value holding those shares. What
Right.
we see now, which is very common, are restricted stock units. So instead of getting one share that vests and is forfeited, you get one unit that's
Mhm.
equivalent to receiving a share in the future. It vests, and then the shares are delivered. The cash should be delivered. And we're saying it's a full value because you're actually the owner. There's no spread. There's
Uh-huh.
spread, you get the appreciation.
Right.
So for partnerships, what is often done is what we call the profits interest or carried interest, which is
Mhm.
actual partnership interest in the appreciated value at the time of grant. So it kind of has some similar features of an option because you're really participating in the waterfall after the value on the data grant. So again, and
Mhm.
it has a great feature in terms of a capital gains treatment. So it's very popular,
Right.
and it's a very good value if it works out. And those
Mhm.
are often on exit is when you have the liquidity. So for the profits interest.
Yeah. Now
Um,
you brought up taxes again too. I just want to circle back to the stock
oh,
option because can be a
mhm.
sticky wicket in terms of
Yeah,
value
I
of the
mean,
options when you buy them, when you sell them, and the tax implications, especially if a company
we're
goes
absolutely
bankrupt and you're stuck with holding options.
well, yeah, because you've been taxed, right? You've exercised and you are taxed with the spread, and then you're holding shares, which may go down in value. So, um, that is, you have a basis in what you're taxed in, but it is
Mhm.
ordinary income based on the spread. But of course, you're not going to exercise it unless the value goes up. Then the problem is, what do you do? How do you get liquidity for the stock? So that's an
Right,
important
right, right. And
piece
then
of it.
how do you, yeah.
Um,
And in some cases, when some of these firms, I forget one of them went bankrupt about 20 years ago and it hit the headlines that you still had to pay the taxes even though the stock options were worth nothing.
There's another issue that comes up, which is very common, is if you give restricted stock, and
Uh-huh.
restricted stock is stock subject to restrictions, so you vest when the restrictions lapse.
Mhm.
However,
Mhm.
there's a special election you can make called an 83B election, which you make
Mhm.
within 30 days of grant. You include that in income, which is good if the value is very low.
Right,
It's a very good planning too. But you pay those taxes whether you forfeit it or not, and you
right.
pay those taxes whether the value, goes down, and there's no way to really undo that. So it is always a planning device, and it always is an issue.
Mhm.
Um, so those are some of the risks, and you can be taxed on something and have then the value of it not be worth it. So from an employee standpoint, you really have to be sort of careful. You also see,
Mhm.
obviously bankruptcy, insolvency, and we all expect, I think everyone expects the value to go up. And as we know, that doesn't always happen. And,
Right.
you know, if you're looking where these awards really can pay off in a significant way is in an exit or sale. But you also have to be careful of that. Like, you want part of the value of the exit and sale is that team staying on. So,
Yeah, absolutely.
sometimes the team stays on, sometimes not. I mean, it depends on if how the deal is structured. So sometimes there's a value to not having everybody be immediately cashed out
Yeah,
if
no,
there's
I mean,
that
yeah.
you want to keep.
Yeah, one of the ones that I was privy to was when Deloitte bought Monitor, the big strategy house. And it started with professors from Harvard Business School. They literally interviewed every partner. I think it was 100 and something, and picked and choose. And it only took about 50% of the partners, and the others were paid a severance or something and let go. So yeah, when you're acquired, really all bets are off. I think most acquirers don't care what your stock options say or what you've got. If you're not going to function within the structure that they've seen and the kind of employee they want or a need they have, they'll fire you. And I don't want to be so hard-hearted as to say that they don't care, but yeah, I'm sure there's a number of people who've been let go. Well, I've heard stories people let go before they vested, for example, and that wasn't honored, or with a certain kind of stock that had taxes applied to it when they got fired, and maybe they got that got stopped dead in its tracks in terms of how you valued those shares, and you hit a low point. Yeah, I mean, a lot of employees, I would think, could potentially get screwed when there's a change in ownership.
Going back to your first question of the biggest
Mhm.
mistake, some of the biggest mistakes, going back, not making those promises, right? And the
Right.
expectations of what folks are going to get. It really takes careful planning and the conditions of what happens if there's a sale and how is equity to be treated, and that's
Right.
complicated. I've seen transactions where promises were made and never papered, and you have a buyer come in and then you have a team that's like, well, you promised me 1% or you promised me 3%,
Yeah.
and it becomes an economic factor in the transaction because the buyer then has to figure out, well, how do we make these people whole? How do we want to get rid of liabilities, we don't want to buy a
Yeah.
company that
Exactly.
has a potential
Exactly.
litigation. So how do we deal with it? And there's dilution and, is there cash? And it becomes a factor in the pricing of the
Mhm.
transaction and the success of the transaction, quite frankly.
Yeah, you
Um,
can bring up a good point, which is preparing for the exit and possibly scaring off potential suitors because of potential liabilities of the complexity of what you've done, or the feeling that the change of ownership is not going to go well because certain people are going to lose because their stocks, their equity is not in a place where it makes sense for them to have to leave. Yeah, we're getting close to the end. Again, this is John Firth. I'm speaking with Gretchen Harders. Um, let's talk now about the reporting requirements that you have when you're starting to issue stock, both for investors, but probably more importantly for employees.
right. So there's a couple different issues that can come up. I mean, it obviously it's a piece of the compensation. So it becomes part of how you're doing your accounting, right? You have
Mhm.
to account for the value of what you've offered. You have
Mhm.
to, if it's a taxable reporting event when there's ordinary income, so that has to be taxed.
Mhm.
If you're
Mhm.
doing in the partnership context, if you're providing profits, interest, or carry, that person is actually a partner, and
Mhm.
will get a K-1 and not a W-2. And that,
Right.
depending on how far, that's one consideration of if you want to give equity to everyone, well, what should that mean? Because, it is complex if if you become a partner and then you receive a K-1, it's not for your entire workforce. Like, I think it creates
Mhm.
other complexities. So, all of
Although
this,
it doesn't, I do know a lot of companies that make it an option. In other words, if they present it as this is an added benefit, but not all of you may be in a situation that you want to take advantage of it, depending on how it's being offered and is it in lieu of
Mhm.
compensation? But um, I don't know how they structured it, but one of my clients had an ESOP going. So there were some people who were not anywhere close to management that had not insignificant portions of equity. And I think the question was just, in my mind, is who would opt not to have it as opposed to have it. But they made it quite optional. It wasn't like it made it blanket, and it's not like they went to individuals. I think they announced it and said, these are the issues you might face with the parameters of which we will grant you a stock, and you have a choice. I think they even had to maybe pay a little bit for it or something. What do you see there in terms of the ability to do this as an option and not necessarily as a must-have or a nice-to-have?
Yeah, you have to be a little bit careful in terms of how that is framed because there are tax issues if you're saying we'll give you cash now versus something else there, then are you if you take
Okay.
the other thing, then are you taxed because you had the right to get cash? So there's
Right.
some complexity that I don't really see that very often. I will make a
Mhm.
point though. One of the things you mentioned is what we call an ESOP, and we have to be careful
Uh-huh.
with terminology because there is
Okay, good.
it was a tax qualified feature of an ESOP, which is actually an employee-owned company. It's a funding vehicle. So
Right.
an
Right.
ESOP, a small company, can be used. You take a loan, use it to buy shares, but that has to be given a share value to all employees. It's a qualified
Okay.
plan, like your 401k. So there's this technical thing which has its own set of issues, but that is really sort of a special way of it's a special financing vehicle, and it provides it's a loan to buy shares, and it's pretty common in in terms of the company. When you sometimes talk about ESOP, it's like a stock option plan or an equity plan that we're giving out. But I think it's challenging if you're saying, do you want this? Do you not want this? I think it raises other tax issues. And I don't see it as often. And if I do see it, usually it's really this is what we're going to offer to you. The person could decline it, but I think some thought should go into, what you're
So
gonna offer.
we have our first question now from somebody called
Oh, okay.
Forrest Cracker. What's the best way to sell my common stock? You're currently owning about 20% of a Delaware C Corp value of $80 million, and a board of directors won't yet want to distribute any of the profits to investors. Do you want me to read that again? I don't know if you
Um,
can see it.
yeah, I mean, I think you're getting into in terms of selling your stock, I mean, one of the things we have to keep in mind is that stock is a security, right? Federal and state
Mhm,
securities laws do apply. So is
mhm.
it, the question is the shares, are they registered? Are they exempt from registration? Is there a
He says
market?
it's
Is
a
there an
Delaware C Corp. It was a Delaware C,
well,
20%
the
of a
question,
Delaware
it
C.
could be, yeah, but is it a listed stock? Is it a private company stock? Is the person an accredited investor? Are there limitations? So who's owning
Okay.
it? It's a complicated question depending on the facts. And one thing to
Okay.
keep in mind is that, you there 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 are limitations on the ability to sell. Can I sell to my next door neighbor?
Yeah.
It is a sale of a security, and there's a lot of different factors that go into it. With a private
So,
company, it's typically there's repurchase, right of first refusal. So it's a little more involved of a question. Yeah.
then that Fur Cracker says it's not listed. It is a privately owned company, Series A. They had raised about 13 million in total. So that 13 million valuation has turned into 80 million over whatever the time is. Does that change your answer or refine it?
Well, it's still the same answer. Is it registered? No, but is it exempt from registration? And to whom can you sell and what sale restrictions there are?
Yeah.
So is there a right of first refusal? There's a lot of, it is, I don't think it's something that we can really answer on this without,
Okay.
uh,
Yeah. And just one point I think I'd want to highlight is he says,
my email is here and I'm
yeah,
happy. Yeah.
exactly. Good.
Yeah.
Unfortunately,
So,
Gretchen, you don't have your full email. It doesn't
oh, it's
show up.
not showing. Yeah.
Yeah.
Um,
But Gretchen at Cohen, what's the full email address?
Cohen, it's two N's at the end of it. So.
Okay. All right. He seems to know how to get in touch with you. If nothing else, you can get in touch with her on LinkedIn. under Gretchen Harder's. So thank you, Gretchen. And I think I certainly realized something I've always known, which is this is far more complicated than I think most people know. And it does get technical very quickly. So in those situations, it's good to have an advisor on your side. And I think that's, if I may add in one more mistake, I think one more mistake is people cut their noses to spite their faces. If you're going to do this, you're walking on very complicated territory that could really turn around and bite you at some point. Get an advisor of some sort. It doesn't have to cost you tons of money, but that is an investment. I think that, what I'm taking away is very well necessary before you make decisions. I don't know if you have anything final to say, Gretchen?
No, otherwise, I've been practicing in this area for some time, and I do think it can be a very useful and valuable tool for
Mhm.
any business, right?
Yep.
But I would echo that it is complicated. So, um, you know, careful planning is really important. But
Yep.
thank you, John, for having me on.
Yeah, no, great having you, Gretchen, and I look forward to continuing the dialogue. And to my visitors and listeners, or viewers and listeners, we will be starting up again with this series sometime end of September, beginning of October, also for about 10 episodes. So I look forward to seeing you there, and I hope everybody has a great summer.